Happy November! I hope everything is going as well as it can for you during these crazy times. This video is an update to the one I did in July, when I gave a heads up to variable rate mortgage holders about your trigger rate and your trigger point. You can find the video on YouTube, but as a quick recap, your trigger rate is reached when your fixed monthly payments are no longer big enough to cover the interest due, so that interest is added onto your mortgage balance. And your trigger point is reached when that growing balance is no longer an acceptable amount to your lender. It's usually when the balance grows beyond a certain percentage of your home's original value. And so with all the rate hikes so far, and another increase expected on December the 7th, a couple Wednesdays from now, I now believe that several borrowers are over their trigger rates. So I'm strongly advising that you connect with your lender as soon as possible to get your loan back on side. Most of my variable clients are with TD banks, so I'll use them as the example. Some TD clients have already received friendly notices from the bank suggesting that they contact TD to discuss bringing their loan back on side. And when the clients have called, TD has quoted the pay down or the increased payment required to get things back on pace. If you haven't yet called TD yourself, then here's the heads up that the figures they initially quote you may be surprising, specifically the increase required to your payment. Your new payment will be quoted based on three things: your current balance, including any accumulated interest, your current rate, and your original amortization. So, to make a very long story short, that $500,000 mortgage that you got a year ago at, say, 1.45% with a 30-year amortization had a payment of roughly $1,700 a month. And to bring that back in line today, your new payment, based on a current rate of 4.95% and a remaining amortization of what is now chronologically 29 years, could be over $2,700 per month. That's $1,000 more. Obviously, this is a major increase. And yet, if you happen to have the room in your household budget to handle it, then I always say that it's best practice to do it so that your loan's amortization remains as in line as possible over the duration of this term. However, with that being said, if you're really feeling the squeeze right now, then a compromise might be possible. What you might be able to do, and a few of my other clients have been getting this done with TD lately, is to increase your payment instead to just enough that at your current higher rate, your mortgage is just barely amortizing. In other words, you're getting yourself back just under your trigger rate. And the way that we do that is calculate a bare minimum increase, and we make that additional payment as a lump sum payment in addition to your regular monthly mortgage payment that's auto-debited from your account. What you need to do is either go online to TD Portal or call the TD Easy line, and the information you need in order to make this estimate is as follows: your current mortgage balance, including any accumulated interest, your current mortgage rate, and your current regular monthly payment. Once you've got this information, you take your current balance and multiply it by your current rate, and this figure is your estimated simple interest for a year. You divide this amount by 12, and you have your estimated monthly interest-only payment. Now, you take your regular current monthly payment, you subtract that from the estimated interest-only payment, and the difference between the two, plus the smallest increase that you can comfortably make, is the additional lump sum payment you should be making. So again, if we pretend your current mortgage balance is exactly $500,000 and your rate is now 4.95%, then a payment of totaling approximately $2,075 should be enough to cover all the interest and ever so slightly pay down some principal each month. So in the case of our example, we leave the original $1,700 payment in place, and we start to make a monthly lump sum payment of $375 on top of it. Not as bad as the alternative of a full pop to $2,700 per month. Keep in mind that if prime continues to increase, as it probably will again on December the 7th, you'll need to recalculate and increase this additional payment again. So keeping this additional payment as a separate lump sum makes it simpler to adjust when prime makes any changes in the future in either direction. So I hope you find this helpful, and before you sign off, I want to give you the heads up about two important things. Number one, fixing this situation while you're over your trigger rate is optional and recommended by me and the bank. But once you've hit your trigger point, then fixing it becomes mandatory and you get less options immediately. TD will likely not allow you to make a minimal increase like I've just described. Instead, they'll probably compel you to simply take the higher payment or make a one-time lump sum paydown, provided you've got the cash, or lock into a fixed rate. Again, what all of this suggests is that regardless of how you decide to remedy your trigger rate, you should take that action sooner than later so as to keep your options open and fend off a trigger point. Reach out to me anytime if you need clarification on the difference. Heads up number 2 is for further down the road. Regardless of what happens to prime and how you manage it during the 5-year term of your variable mortgage, your lender will likely square everything up again at the beginning of your next term, or the end of this 5-year term now, so that your mortgage's original amortization is put back on track chronologically. So if your 5-year variable began with a 30-year amortization, then at the end of this 5-year term, your lender will rejig everything so that your amortization is at 25 years, regardless of which term and rate you decide to renew into. Plain English, this rejigging could result in a bump up in your payments. How little or how much your amortization ultimately stretches during this 5-year term we're now in with all these rate increases will then come to roost. For now, do what you can and tackle it sooner than later. So to wind this video up, I advise you to contact your lender to see where you are. Gather the information you need, do some math, and take immediate action against your trigger rate in order to keep your options open to you down the road and get out ahead of any potential trigger point. As always, I'm here to help. Don't hesitate to reach out for any reason, need some help with this math, etc. That's all for now, though. Stay tuned for more information in the future. Cheers.